Welcome to Brick by Brick. Join me, Lauren Wernette, as I share my personal journey of building a thriving real estate and hard money lending business from the ground up. Along the way, we'll explore the strategies, challenges, and breakthroughs that come with growing wealth. Whether you're a seasoned investor or aspiring entrepreneur, or simply curious about the world of private lending and real estate, this podcast is packed with actionable insights, real-world stories, and mindset tips to help you build your own path to success brick by brick. Hey, welcome to another episode of Brick by Brick. I'm your host, Lauren Wernette. Today we have someone that I met last year at a family office meeting, which we can talk about here in a little bit. Alex Brown is with us. Alex is a founder and owner of a venture capitalist firm out of Boston, Massachusetts. He's got a very interesting background on how he's gotten to where he is today. And I'm really looking forward to talking to him about a subject that we haven't really explored much in the podcast to date. So Alex, thanks for joining.
Hey, Lauren. Thanks. My pleasure to be here, and it's great to catch up again.
Yeah. So as I mentioned, we met at a family office meeting about a year ago, a little less than a year ago now. And for those that don't know, family office are these large groups of people or families that have a large amount of money, and they look for places to deploy capital. And Alex and I just kind of always met at the back of the room to talk about things throughout the event. And I really enjoyed talking to him. I really enjoyed his insights. I really enjoyed, what he was doing. And so I thought it'd be really valuable to have you on. But I think nobody can explain who you are or what you do better than you. So can you give us an overview of what you're doing currently, how you got there, and kind of your general ethos on life that's propelled you to where you are today?
Perfect. Let me start with where I am now. And then in the spirit of brick by brick and building to things over time, I'm happy to give you the long and winding path that got me to where I am at the moment. But at the moment, I'm a managing director of a small venture capital fund called Beacon Venture Partners. We're currently deploying out of our third fund. We actually started doing this in 2019, and about every 3 years or so, we've launched a new fund in order to keep investing. We invest primarily in pre-seed and seed stage companies, largely drawn from the greater New England area, which is a sometimes overlooked but very active bed of entrepreneurship in the United States. We're looking for companies that are very capital efficient. And everyone says they're looking for capital efficiency, but for us, that means we're looking for companies that we think can get to a 10x or better exit, meaning they exit for 10 times what we invested in them within about a 5-year window and raising less than $5 to $10 million of total outside capital. And the advantage of that is, the mythology of venture capital is that unicorns are a dime a dozen and they're being constantly minted all over the place. It turns out they're still vanishingly rare, even in the really high-flying days of 2021, 2022. Yeah, maybe less than 0.1% of companies end up getting a more than $1 billion valuation. A lot of them end up getting valuations in the roughly $100 million range. And so if you only needed to invest $5 to $10 million, then even an exit in the $100 million range is still a very good return on capital. Whereas this focus on unicorns that's always struck me as a bit off the mark. I don't really care if you have $1 billion valuation if you needed to raise $900 million of capital to get there. That's a terrible return on your investment.
Right.
So we're looking for really efficient investments. Now, the way I got there, you would never have guessed that that's where I would end up. I actually have an undergraduate and a master's degree in civil engineering, which is part of the reason why I've always enjoyed our conversations about investments in real estate and construction. And it's very much an area where I have background and passion. I worked for a number of years as a transportation planner, working on large infrastructure projects like the notorious Big Dig here in Boston. At some point, I realized that a lot of these great projects weren't being built because of financial considerations. Not so much the technical and engineering side, but the project financing and the cost-benefit analysis of how much they were actually going to yield. I decided to go back to business school. I got an MBA. I had all of the noble intent to go into socially responsible for-profit entrepreneurship, and then got a little sidetracked. When the major consulting firms backed up a truck and loaded a third of the class in and took them away after business school, I was on the BCG truck. And so I went to the Boston Consulting Group, spent about 6 years there, was on the cusp of becoming a partner in management consulting, when I remembered that I actually never had aspired to be a partner at a management consulting firm. I'd sort of viewed it as a 2-year kind of post-grad experience. And so I decided it was time to move on, or I was going to really start to grow roots and it was going to get harder to move on. But that was kind of the source of the initial wealth that I started to use as an investor moving forward from there. I knew I didn't want to go work for an enormous company, so I cast around for early stage companies here in the greater Boston area and stumbled upon one called Scrum Inc., which I don't know if you or any of your guests are familiar with the software industry and know anything about Scrum, the product development framework or project management framework. These are the folks that invented Scrum. And so I worked with them closely as their chief operating officer. And it happened to be a really interesting time in the history of the evolution of Scrum. It went in the 5 or so years that I was there from being kind of a fringe methodology used by a couple of out there software development firms to being one of the recognized anchors of the software development industry, and today used by probably about 95 to 98% of software development companies, at least notionally. And so really had the experience of taking a small company and building it into a much larger company, that sort of entrepreneurial experience. And I was hooked. I knew I could never go back and work for a Fortune 100, Fortune 50 company again. The ability to talk about something on Monday and have it implemented by the end of the week is just so enlightening and uplifting and energizing that I knew was the space that I wanted to stay. I actually did get temporarily lured back into consulting by some BCG colleagues, and it took me less than a year to remember why I had left. And since then, I've been either a professional investor or doing some advisory and independent board and support for startups and early stage companies since then.
Well, little known fact, in my last W2 job, I was a product owner in an agile environment. They called it agile. We were like Scrum Fall is what I called it. It was a mixture of waterfall and Scrum. Beside the point. So as you're making this transition kind of through your career and you say, hey, I want to do this and do investing, did you already have a strong understanding of like what the venture culture world or looked like? Or did you kind of say, this is what I want to do and kind of fell into it? What did that look like?
It was the consummate, totally fell into it. If you had asked me even 7 years ago if I would ever work in venture capital, I would have said, no way. I like building real things. I don't necessarily like moving decimal points around and stewarding cash and capital, but I totally fell into it. I had been investing as an individual in angel investing, kind of early stage investing with a group here in the Boston area called Launchpad Venture Group. And as an individual, not only did I need to research the companies and decide whether they passed a sort of minimum threshold of investability, I then also needed to think, well, if I'm trying to do this on a budget and I really only have the budget to make 3 investments a year, is this going to be one of the 3 investments that I make this year? And sometimes due to timing, you didn't make an investment that you wish you had, or you made an investment that you wish you didn't. The company that came through Launchpad that has been the most successful investment in the 22-year history of Launchpad happened to come through in March, April of the year. I thought, okay, it's good, it's investable, but it's still early in the year. Let me save some of my investments for later. I passed on that investment. That investment made 100x return on the capital investment. And whether you were in that or not had a huge impact on your overall portfolio returns as an investor. And so that was the moment where I realized if I want to do this seriously and not just as a kind of country club type affair, I really need to diversify. I need to get a diversified portfolio of investments in this space because it is much more costly to miss out on that 1 in 10 that is a next or better return than it is even to invest in another 3 or 4 companies that end up going under and you get no return. You can only lose 100% of what you invest, but you could make 100 times what you invest in a successful upplace. And so a colleague of mine and I, who is now my fellow general partner in the fund, had this similar idea at the same time. And we looked around for somebody who was building this diversification vehicle. And we said, well, we'll sign up for it. And that's how we'll ensure that we're actually making a return in this highly risky space, high reward, but high risk. And after looking around, we realized that nobody was doing this. And that's when we had the perhaps naive thought of, well, if nobody else is going to do this, why don't we just do it? And so we started very small, $1 million, basically pooled investment vehicle, a member managed fund of fellow investors in this angel group. And before long, we were raising our third fund, and this has actually become more of an occupation, but something that I found I really enjoy. I wouldn't have thought I would enjoy it, but I really enjoy the analytical and the critical decision making that comes behind it, and the spirit of actually investing in the world as you'd like it to be. All of these up and coming opportunities that hopefully have the chance to make the world.
That's awesome. It's amazing what you can find that you like doing once you open yourself up to exploring different things besides what, kind of you're set in stone or set towards doing when you're younger, and you just kind of follow that path, right? I found similar thing in my lending business. Never would have thought that I would enjoy lending. I thought that I would always like to be hands-on, more real estate focused, but the lending is just something that I've really found that I like. It's all the pieces of that what I'm good at without a lot of the things that I'm not good at. Those pieces are kind of distilled out. So can we take a step back? Because I know some of my investors or some of my listeners maybe aren't as familiar with the VC space. And so can you just give a high level overview of what VC is, what kind of the investor profile is of someone that's doing that, and what are the things / companies that you're investing in, not specifically you, where is those monies going, and how are those returns structured?
Yeah, so the first disclaimer I should give is that calling VC an industry is sort of like calling consulting an industry. And I've been in both. There are lots of different flavors of consulting, and similarly, there are lots of different flavors of venture capital. Basically, what unites all of the flavors of venture capital is you are investing in private companies. So they're not listed on any sort of public exchange. You can't just buy shares in them or trade in the way that you would in something on the NASDAQ or something listed on the New York Stock Exchange. There are a number of different vehicles that you can invest in these companies, mostly equity. You actually buy what are called preferred shares, ideally, but you also, there are debt lending ways that you can lend money to companies. There are more contractually based. I won't bore you with those details. And you're investing with the expectation that these small, fast-growing companies are going to do something very disruptive in the world. They have typically some sort of technology that allows them to be vastly more efficient, or to create whole new markets, or do things in a much more efficient way than they've been done in the past. We really like to focus on companies that solve clearly defined, significant problems for their customers. The sort of thing that would keep the customer up at night, just wishing, gee, who out there solves this kind of problem? And I'm happy to give some specific examples of the types of companies that we've invested in. But the way you get your money out of these investments typically is when these companies either get large enough that they go public in an initial public offering, an IPO, and then you have publicly tradable shares that you can sell. Hopefully those shares are significantly more valuable per share than when you invested, when it was a highly risky, uncertain business. Or in our case, much more typically, these companies get acquired by another large company that wants the capability or the technology or the solution that they've developed to bolt on to their. And acquisitions, exit by acquisition, is much more common than IPOs. It's, again, part of the mythology of VC that everyone exits to a multi-billion-dollar IPO. Nah, something like 75 or 80% of exits are acquisition by another large company. So that's kind of what unites VC. There are people that invest in a particular discipline like healthcare or fintech or insurance tech. We tend to be a little bit more of an industry generalist, but more geographically focused in an area where we can make connections. We can introduce people to customers. We can help circle other knowledgeable investors. We have some consulting background so that we can help advise companies on how to spend their money wisely, what to build when in order to maximize their growth prospects, things along those lines.
Got it. So the value proposition for either side is the company essentially needs cash to grow, and they're willing to give up equity or special interest or whatever, however they structure it. And then the investor, they have cash that they want to invest in something, and they're looking for a company that has the capacity and they see the vision of where they're headed. And so you pair those together. One person gets equity, one person gets cash, and hopefully you grow to the moon. In most cases, some big company like Amazon is going to see some widget or some piece of it that they like, they're going to buy the whole thing, maybe strip out a big chunk of it and take that piece they want and include it into their tech stack or into their...
Exactly. The companies at this early stage are burning cash much faster than they're generating revenue. And so they are net consumers of cash for some period of time. VCs sort of step into the void and provide that cash, hopefully to get them over the threshold of having more revenue or getting revenue faster than they burn cash to become a viable going concern business. And hopefully not too long after that, there's an exit opportunity in one, typically acquisition.
Got it. So can you walk us through like how you vet some of these companies, and then maybe give us, like you're talking about, the example of some companies that you invested with in the past, and if your vetting turned into reality when you actually started moving forward after the investment?
Yeah, so we actually do a notoriously thorough what's called due diligence process on all of these companies. We frequently are told by the companies afterwards, that was it was like getting a colonoscopy. It was really intense, but we actually, in the good cases, we appreciate it because you pointed out a whole bunch of questions that we hadn't necessarily thought about, that we actually did need to think about, and it set us up for success down the road. So we have a very structured process. We look first and foremost at the leadership of the company. I'm a strong believer that a solid, capable leadership team will do better even with a not great idea than a mediocre leadership team will do with a great idea. Because inevitably, all of these companies are going to bump into hurdles and obstacles. They're going to suffer setbacks. And so a great leadership team is going to find a way to push through and persevere in the face of those setbacks in a way that a less talented leadership team might panic or get distracted or start squandering their effort on lots of different unproductive activities. So does it seem like the team has the skill set and the mindset in order to be successful in a pretty challenging field of building a company from scratch? Is the product real? Can it be done? People have heard of Theranos from a Bay Area company. Their investors should have known that what they were trying to do is physically impossible in a Newtonian universe. So that's the sort of thing that can be revealed in diligence if you actually take the time to step back and think about it. Does the product work? Does it solve a meaningful enough problem for a large enough market of people that you can really make a business around it? And can you reach that customer easily enough and inexpensively enough that you're not going to burn through tons and tons of capital just trying to convince people that they have this problem that you can solve? It should be an obvious enough problem that they seek you out.
Mm-hmm.
Is the financial plan solid? Are they thinking about how much it's going to cost to get this company to be a going concern, a successful company the right way? Or are they naively assuming exponential growth of revenues and costs that stay very low and don't scale as the company gets larger? Do they have defensibility against competitors? A lot of people will say they're looking for companies that have no competitors. A lot of companies will say they have no competitors. But show me a startup with no competitors, and I'll show you a company with no market or business. Mm-hmm. Actually, having competitors is a good thing. It means that there's a real market there. It's somebody to help with educating the customer on the value of needing this. What's important, though, is how do you differentiate yourself from the competitor? How can you sustainably show that you are a better solution or a better product and that somebody should prefer you? Patents and IP is one way you do that, but there are lots of ways that you can defend your business concept from others just copying it and trying to pull off some of your market. And then have they actually thought about how they're going to exit at the end of the day? Is this just a lifestyle business that they want to keep doing and growing slowly? Or is there a reasonable buyer for this business or a credible chance that they can actually grow it large enough to have an IPO and take the company? So we try.
How often do you see where they come in and maybe they have a great product, great marketing plan, but they just lack the financial prowess to build that plan out correctly? Or they have a great financial plan and their product maybe is not hitting the mark, or maybe the product's good, their marketing just isn't as good. How often do you see that disconnect? And do you, once you come in, do you offer to help fix that? Or do you say, well, no, we don't have all three pieces of this triangle, and so we're not interested in this investment?
That's an excellent question, Lauren. And we very frequently see mismatches. The most common, particularly here in the Northeast, we've got Harvard and MIT and a bunch of very smart technical people in the area. The most common thing we see is a very technically skilled leadership team that may lack the business savvy and experience to take a technical concept and turn it into a real business. We sometimes see the reverse, but it's definitely much more often a technical founder who's really enamored with the capabilities of the product and maybe hasn't thought through as much the business considerations and aspects. Fortunately, that's an area where we can help. And so if we think it's a gap that we can bridge, we can introduce them to a new chief marketing officer, a CFO, possibly even a CEO to really lead the company and have that business experience. We're happy to do that. Honestly, even if we don't invest, we consider ourselves sort of stewards of the entrepreneurial ecosystem, and we want companies to succeed. But particularly if we've made an investment, then we have chips on the table, and we are highly motivated to ensure that these companies succeed. So I've even myself stepped in as an interim chief operating officer for some of these companies when the market was solid, the value proposition was solid, but the product needed a little boost of capability in order to get where it needed to. So we tend to sit on boards in order to take a more hands-on approach, and we'll even step into management roles if we think that will help get the company over the finish line.
I think that's a very valuable piece. As somebody that's basically running a startup right now, it's very easy for a founder to have a specific skill set that sets them apart in the market, and they just struggle in some of the other components. And so as a founder, you've got to find mentors, you've got to be constantly learning, you've got to join groups, you've got to try to figure out how to get past that hurdle that is your weak spot. And a lot of times it's bringing somebody in, but the people that you need to bring in are often priced out of your price range, right? And so it leaves you in this funny spot where you can't get over that hurdle without just a long slog or taking large chunks of money and giving away equity in order to bring in those pieces that help you grow. And that's a big mental hurdle and struggle for a lot of new entrepreneur founders.
Yeah, if you think about it, we have just an inhuman expectation of founders. I have tremendous respect for people who have the bravery to start a company from scratch. But you're thinking the ideal CEO or ideal founder is charismatic and can sell to customers and can sell to investors. They're technically very savvy and they understand the product and the market that they're trying to serve perfectly. They have great business acumen and they know when to time certain decisions and how to deploy capital and do all of those things. Very few people actually combine all of those skills in one person. More often than not, you're strong in one area, maybe very technically capable, and you need to find somebody to round out the team who carries the business end, the sales end, the performance aspects, and the charisma of what it takes to be successful. So a lot of it is team building and making sure that all of those skills are resident somewhere in the company. They don't necessarily all need to be resident.
And I think what I've also seen is someone that's, I've seen people that are charismatic and they have technical skills, but they lack the ability to make the team. And then what happens is they struggle to give away control of tasks because they don't think anybody else can do it as good as they can. And then it stagnates the whole company because everything runs through one person, right? And that person is heavily overworked.
Right. Yeah. When the founder becomes the bottleneck, that's a very frequent dysfunction that we see in a lot of these companies. that you then need to advise, hey, not everything needs to be on your plate. Let's find some capable lieutenants that you can delegate entire sections of the business to and trust that it's going to get done. You'd mentioned earlier it's hard to pay those people, which it is in cash. Typically in these startup companies, what happens is they get large equity grants, which means you're subsisting on a lower cash income for a couple of years while you're building the business. But hopefully those equity grants turn into millions of dollars of company stock down the road when the investors get the exit as well.
Life. I know a guy that was making, close to $500,000 a year for his W-2 and then took a job as like COO of a company in Texas. And it went from like $480,000 a year to $60,000 a year, right? But it's a long-term play on what you think that company's value is going to be in the future. And then you put all your eggs in that basket.
Yeah, to get off the ramen and hot dog diet as quickly as you can. It's part of the reason I have so much respect for founders because they're making that explicit calculus. And you might not think it, but we as investors give a lot of thought to what's the incentive for the key leaders on the team. Do they have enough of a pot of gold at the end of the runway to make it worth their while? They could be making $300,000, $400,000 a year in a traditional corporate job, they're consciously foregoing that. We want to see them with at least $7 to $10 million of potential upside at the end in order to properly motivate them to try to have this company succeed.
I think that's a really good point because, most people think about VC or private equity guys as, they're coming in and they're basically going to come steal your company. They don't care what the founders are going to make. They're going to take your company. They're going to leave the founder destitute, right? And what you're saying is totally opposite of that trope, in that they actually want the founder to do extremely well because it's highly motivated for that founder to make their investment worth it.
I obviously can't speak for all VCs out there, and there probably are some out there that are a little more sharp-elbowed and cutthroat like that. But my philosophy is, who's going to bring their company to me for investment if we have a track record of kicking the founders out and leaving them destitute and taking the idea and trying to take all of the profit? So that's even just like the self-serving argument for why you shouldn't do that. But again, our philosophy is much more being stewards of the entrepreneurial ecosystem. And that would be completely counter to that philosophy to try to hoard all of the returns. That's not to say we always agree with founders. It's not to say that we don't occasionally need to replace senior leaders in an organization because of missteps or we found somebody who we think actually would be a better leader. But one way or the other, we want their equity in the company to be worth something at the end of the day, and hopefully worth a lot.
Awesome. So you were starting to get into an example of one that you've worked with. So can you walk us through, and I don't know how much detail you can give or want to give, but one of the companies that you have invested in, kind of what that vetting process looked like, and then how the process while you were invested in, and if there was an exit.
Got it. So we're early enough in, even with our third fund of investment, to take a small company and turn it into a successful exit. We shoot for something that can happen in about 5 years' time. In reality, it takes probably closer to 10 to 15 years. And so we don't have a ton of huge name brand type exits that we have invested in at this point, not least because we tend to focus, as I mentioned before, on kind of unsexy but meaningful problem solving smaller businesses. And so, one that we're pretty excited about at the moment is a company called, they've actually just changed their name to Mako. It used to be A2 Labs. And not everything we invest in is AI. There is a lot of buzz around artificial intelligence at the moment. This does happen to be a play, but it solves a real problem within the AI space. It's not just adding AI to a existing problem that's been around for a while. But one of the key issues in the AI space at the moment, and the reason NVIDIA has been on a tear until somewhat recently in terms of their stock valuation, is because not only does NVIDIA make some of the arguably best chips for artificial intelligence calculations, but they actually make the dominant programming language for writing scripts for artificial intelligence. And so that's led to a big discrepancy in the price that people are willing to pay for NVIDIA chips versus AMD or any of the other chip manufacturers that also make graphical processing units that are used for AI calculation. It's like a 10-to-1 ratio of what somebody's willing to pay for an hour of a NVIDIA chip versus an AMD chip. Because to use the AMD chip, they would need to write all of their software on a different language than the one that everybody uses. And so what this company does is they create a middle layer. And so you can write your AI program on Coda, the NVIDIA language, and they will map it to and compile it to any different chip that you want. And so you can pay a lot less for the chip, write the same program that you would, and it's a way to smooth out some of this arbitrage opportunity. If it works, it could be huge. So this has definitely the possibility to be that sort of X return on investment, but it remains to be seen whether it fully works as it's intended. And even if it does fully work as it's intended, does it attract a sufficient market opportunity, or does it very quickly smooth out the value difference between NVIDIA and AMD chips and they destroy their own value proposition? So high risk, high return. The diligence process for that mostly was looking at the team and does this feel technically feasible? A very solid team out of MIT, an institution people may have heard about, known for high-end innovative developments. We had spoken directly to a couple of their intended customers who were all very enthusiastic about, yes, this would really alleviate a major headache that we have in the industry. It looked like the team had the broad set of skills and was far enough along in the proof of concept of the technical feasibility of this that we decided to invest in it. So that was probably about 2 years ago. They have since actually started to commercially roll out offerings. They've gotten some large contracts. Not surprisingly, AMD is very interested in collaborating with them, and so they're on that path, on a trajectory that looks like they're going to fulfill that prospect of where the value.
So talk to me about the vetting of the team members themselves. So like what, and it doesn't have to be just about those specific team, but like when you're looking at team members or founders, like what are some characteristics or traits that you really want to see, and what are some that are just like deal breakers? Like if they have this, like we're not going to work.
Yep. So there are a lot of different flavors of things that would be wonderful to see. You generally want technical capability and competence, somebody who is credibly an expert in the domain that they're starting up. You know, the mythology in venture capital is that successful entrepreneurs are college dropouts in their 20s who are going to totally reinvent an industry. The reality is actually more like successful entrepreneurs are people in their 40s who have decent amount of experience in the industry they're trying to disrupt. They've experienced all of the pain that they're trying to alleviate. And so looking for that kind of credible background of somebody who could reasonably be expected to understand the industry and the pain and have come up with a better solution. In terms of things that we try to avoid, we actually do something kind of sneaky, which is we pay particular attention to how they interact with administrative staff and people as we're scheduling meetings and doing the kind of quotidian day-to-day stuff that you need to do to sign them up for a pitch and arrange scheduling and things along those lines. If they are rude or horrible or really mean to some of the less titled people in the organization, often that's a sign when their guard is down of how they actually sort of view the world around them. And that can be a major red flag. That somebody who may be a little bit of an egotist has this vision of how they're going to be the next celebrity CEO and is just kind of going through the motions and looking to get cash. That's an interesting way to sort of sniff that out and sense whether somebody really is motivated by a desire to build a successful business rather than just sort of pump and dump a sexy concept.
I mean, I think that general mindset is going to hurt them just in the long run everywhere, because they might be like that around support staff, but they're also going to act like that around competition. And while the movies and everything tries to make business look super cutthroat, like there's a lot of collaboration that has to happen. And if you just start going around screwing everybody, like it's going to become pretty common knowledge. Don't do business.
Yeah, it happens very quickly. And we as early investors have a lot of risk because they're probably going to need more money down the road. And we lose a lot of our leverage after we have written the check initially. We're too small to write the $5 and $10 million checks that they may need down the road. Whoever writes those checks doesn't necessarily have a strong incentive to take care of us. And so we're really putting a lot of trust in the entrepreneur that they're going to appreciate that we were able to get them from 0 to 1. And when they're going from 1 to 10, be appreciative enough not to hose us. So somebody who's showing signs of being willing to hose you at the drop of a bat early on, that's already a major source of risk for us.
Yeah, maybe not directly applicable, but similar tone. There's somebody that I really respect in the private lending space that works in South Carolina. And they always say when talking to borrowers, if you can't get them to communicate with you quickly and effectively when you're trying to give them money, they are not going to effectively communicate with you when you're trying to get your money back.
Fair enough. Yep. So we typically have contractual requirements that they need to communicate back with us at a certain frequency. That's not to say that those contractual arrangements are always met. But yeah, the rapport that you build with somebody, it's a tremendous amount of trust in an individual, whatever the documents say. And so does this person have the integrity and the credibility, not only in the technical field that they're working in, but as a business partner and somebody that you're going to be locked up with in as illiquid a way as you can be for a decade or more. Once you invest in these companies, there is no way to get your money back short of having them exit. So you're bedfellows for better or worse for a long period of time.
Yeah, then I think that's a mindset that a lot of investors that work in real estate would have a hard time getting behind, right? Because even like our fund, it's you can get your money back in 6 months. You talk about a lot of private or equity funds where you're going into multifamilies. I mean, you can't get it out, but you know that there's a hard asset sitting out there that if something happened, it will sell and you will get your money back. But I mean, if the cycle's wrong for you, like there just straight up might not be anything there for anything for a year or two or 10 or however long.
Well,
And you just kind of have to
or
wait and
ever for
hope,
that matter. I
or
mean,
ever.
a lot of this is a statistics game. We know from past experience that about half of these companies are not going to return the money that we invested in. They may return some portion of it, some cents on the dollar, but they're not going to return the dollar that we put in. But 1 in 10 is going to return 10x or more the money that we put in, and that's really what pays for the half of the portfolio that doesn't pay out. And then everything else in between, the sort of 2x, 3x, 4x, 5x, is really what makes the returns of the fund. If that sounds horrible, our very thorough diligence process actually brings that 50% failure rate down from what is the industry average 75% failure rate. So there is this sort of picture of venture as the streets are paved with gold. They can be. When there are positive returns that you hear about, they're very positive. But keep in mind that there's that risk side that accompanies the reward side. And so you need to take a pretty systematic approach to it.
Sounds like the streets are paved in gold, but you walk on them with ulcers.
Yeah, exactly. The streets are paved with gold, but there have been a lot of horses walking around for a while.
All right, so going back to our example company here, so you're in, or we can change to a different one, but you're in the process now. I guess the one question I have is, what happens, or what does it look like when you do get a founder or investment in, and now like they're great people, but now they're asking a lot. Like all of a sudden they think that you are their ultimate mentor and you are their first phone call every time anything goes wrong. Like how does that relationship work, and what's the transition to get yourself out of being an active member and more of a passive member of this investment?
Well, honestly, that would not be a terrible problem to have. In my view, I would rather be the first call, and then I can sort of farm out responses to a Rolodex of people that could potentially help. Much more common is the opposite, which is you write the check into a company and then you don't hear anything back, and you periodically need to ring them up for updates, and or the only time you hear back from them is when they need more money, and you get a couple of weeks notice, and then you have to have some very hard conversations around, well, I can't really help you easily if I don't know what's going on. So we devote a lot of time and energy to actually trying to stay on top of and have visibility into what's going on with the portfolio. You have to manage your time. Part of the advantage that I have is I work within the greater context of still collaborating heavily with Launchpad, the angel group. So Launchpad has 180 members who are all former CEOs, business leaders, expertise in a lot of different areas. We can pick a series of board members for the portfolio companies out of a large and very qualified pool. So I personally don't need to sit on a dozen different boards. We have 27 companies in the portfolio for Fund 2. I only sit on one board. And so I can really give it my focus and attention. And I sit on that board because it's a topic, an area where I have particular expertise and I really can be helpful. All of the other companies, we've paired up with a board member who similarly has domain expertise in the area. So it actually ends up being a pretty manageable lift in terms of supporting the companies. But it's because we're building on a really solid foundation of people interested in supporting the portfolio. I would much rather that than thanks for the check. I'll see you in 2 years when we need another infusion of cash.
Right. That's got to be tough on your side, especially if you've got investors involved, because I'm sure they're looking for updates from you, and it puts you in the middle of trying to dig information out of somebody that's not responding and somebody else that wants to get that information so they can sleep better at night.
Yeah, I mean, our hallmark is transparency. So what we know, we make sure to pass on to the investors. And if part of that answer is, hey, we're not hearing much responsiveness from this company, we've done some web searches, we're not seeing much in the news about them either, that's often a leading indicator that they're in trouble, and that sort of tempers our expectations around what the likely outcome from that investment is.
Got it. And so talk me through what that looks like when things go south between you and the founder. And then I guess you haven't had an exit yet, but I'd be interested to hear what you expect
I should
things
say
look like
we
when
have
they
had a
go.
number of exits.
Okay, you have
We
it.
can
Okay.
get early exits. If something happens to be just at the right time, matches onto a portfolio, they get snapped up by a large company. The early exits tend to be smaller exits, twice the value that you invested initially, sort of a 2x return. Not necessarily what venture capitalists like to write home about. We prefer to talk about our, 10, 15, 20x returns, and those typically take longer. But you were saying kind of what happens when the company
Yeah, I mean, just talk me through like what the whole chain of events is when things go south, and mostly I'm interested in what the communication between you and the founder, the company is, and then what the communication and relationship between you and the investors are. And everyone knows that these are high risk investments going in, but I'm interested to hear how you handle that so that everybody leaves feeling pretty good and knowing that there's others on the horizon that they can move into.
Yeah, but we try to give everybody a fair shake, but we go into it knowing that not all of these companies are going to survive. Probably a very good example there is we invested in 2019 in a company that had a technology to videotape Little League baseball and or college baseball games, and using AI, pull out individual footage and clips of individual players so that they could essentially automatically generate a highlights reel to support their college recruiting or their MLB recruiting prospects. Cool technology, very cool technology at the time. They hit the market in 2019, just in time for COVID to shut down pretty much all Little League and college sports for the period of a year or more. The CEO actually was very attuned to that and astute, cut costs very quickly in order to weather that period of time, continued to develop the product while they couldn't actually be in market, but they needed to burn a lot more cash in the process to sustain themselves to do that. And then a year and a half later, when they relaunched in a newly restarted baseball season, the leagues were just getting up to speed, so they weren't in a particularly experimental mood to try new technologies. It took longer to get into the market. Again, more and more cash is getting consumed. And then as they started to pick up and convince the market of the value of this, generative AI really took off. And suddenly what was their secret sauce, the thing that they could do uniquely that was really hard to do otherwise, became much easier to do. And so the timing just happened to not work out, and their window of opportunity really closed around them. And so they are wound down earlier this year. From our perspective, we've been in communication with the founder this entire time. How can we help? Obviously, we can't reopen baseball. If it's closed for a period of time, we can advise on where to spend time and energy in terms of product development. And at some point, the advice we have to give is, I don't think this is going to work. And I don't think you're going to be able to raise additional funds to keep it going that way.
It's a great example of a good product that this didn't work, because like I can go on my phone right now, and we talk about my son plays travel baseball. And so I can go on my phone right now and go to the app that everyone uses for that and do exactly what you're saying. I get AI update of everything, of the box score, everything that happened, clips of every time he went to bat, all of those things. So that product exists. It's just built into other software that's currently on the market and being leveraged by everybody.
Well, ironically, you may actually be using this company's technology as you do that, and it's sort of baked in. And so the technology will probably get acquired, but not in a way that's likely to generate significant returns for the investors. And we've been giving quarterly updates to the investors on the entire portfolio as it goes. And so they were informed when COVID shut down the baseball season. They were informed when new technology started to reduce the uniqueness of this company. They were informed last quarter that things were probably going to wind down. There are some interesting things about venture capital from an investor's standpoint that make failed companies not as painful as they might otherwise seem, which is you can generally write off those losses against other income. And there are some tax advantages where you often can get some of these 10x returns entirely free of capital gains if the company was small enough when you first invested and they've maintained their qualified small business status since then. So that also tends to move the needle a little in favor of the investor actually making a return. And it's because the government has realized that a willingness to invest in these sort of risky early stage companies actually helps build and support the economy going forward. And so there are good societal reasons why you want to help moderate some of the risk of what that kind of investing does.
There's lots of things that you can say about the government, but their tax code definitely tells a story, and it is a story of trying to support real estate and entrepreneurial growth to generate businesses, to grow, to hire more people, to stimulate the economy.
Yeah, to build communities, they're generally viewed as good societal goals.
I don't want to hold you up. We're getting close to the end of our time. We had a great conversation here. Just as we get kind of wrap up, I think the question I always ask all my guests is, knowing what you know today, if you could go back to yourself when you were 20 years old and give yourself advice, or if you could talk to your children when they are 18, 19, 20, what would you tell them as, a couple pieces or one piece of advice to help them move their life forward in a positive?
So I actually have a now 7-year-old. So this is very apropos. I'm already starting to think about what kind of a career advice to give. She's a little young for heavy career advice at this point, but what will I be saying? My path has ended up being a meandering path. It's not what I would have thought. I would be an astronaut now if I did what I had intended to do when I was 7 or 8 years old. So you can put yourself in the path of opportunity, but then you also need to be flexible enough to recognize that opportunity when it comes around, and not scared to take some of those risks and take some of the leaps to pursue some of those goals. So useful to have a concept of where you'd like to go, but recognize that I'm about to turn 50 and I'm still wondering what I'm going to do when I grow up. I don't think I've necessarily found that yet. So people often feel a real rush to make that decision very early on. I don't think you have to. The world is a really interesting place. It has a lot of unique opportunities. It has a lot of needs. And so equip yourself with a diverse set of skills that can plug into a lot of different environments, and then hang on and see where that ride takes you. It's pretty fun.
I love it. What a great message to end on, of just the world is your oyster, right? And just keep being flexible and moving the ball forward. This has been a great interview, Alex. I really appreciate your time. If people want to reach out and learn more about what you're doing or just get in contact with you, where's the best place for them to contact?
So email is probably best. And I think you're going to write it down in the notes because our email address is a little tortured, but it's alex@beaconventurepartners.com. I do read all of the email addresses, and I'm usually pretty responsive. If somebody just wants to mention that they encountered me in this context, that's helpful.
I will make sure that's in the show notes. I'll also include your LinkedIn profile page so people can see all of the different things that you've done, which is quite a long list of impressive feats. So thank you again for your time. It was a pleasure. And thank you guys all for listening. I look forward to talking to you next week. Thanks for tuning in to Brick by Brick Wealth Building Conversations. If you enjoyed today's episode, don't forget to subscribe and leave a review. It helps more people find the show. For more tips, resources, and updates on my journey, follow me on Invest with Lauren. Let's keep building wealth, one brick at a time. See you next week.